Hello, everyone, and welcome to our Mortgage Playbook webinar, Boost Builder Business in the New Mortgage Market. I am Allie Wolf, and I'm pleased to be joined today by Nicollette Chapman, our Vice President of National Sales for Mortgage. Before we begin, please note that we will be recording today's session. So if you miss anything, don't worry, we'll send it to you within the next 24 hours. Further, feel free to submit questions at any time. I suspect we won't have time to squeeze any in today, but you're welcome to ask, and if we have any extra, we're happy to take them. We're here today because of our Mortgage Pro platform. As you'll hear in today's presentation, the new home market is an increasingly important part of the housing landscape. Mortgage Pro was designed to help you secure more builder business by quickly identifying opportunities to develop new builder relationships and increase market share. As we think about the importance of the new home market, I'm pleased to share that our Livable website is now live. Livable is North America's most comprehensive and accurate listing platform for new construction homes. Our free-to-list site is dedicated to helping builders showcase their homes in communities. As you listen to today's presentation, you may be curious to learn more about pricing, sales, or supply in a certain market. If you go to zondahome.com/market-snapshot, you can get a free market report for one of the top 65 metros across the country. Finally, webinars are perfect for efficiency, but if you're looking for more in-person networking opportunities, please check out our upcoming events. Feel free to register and join us at one of them across the country. That includes the Pacific Coast Builders Conference. PCBC is at the end of next month in Southern California, where you can explore the future of home building. You can use the promo code ZONDA to receive complimentary exhibit pass registration or $150 off a max pass. Now, today's agenda. I have about 20 minutes to go through the housing update before I pass over to Nicollette, where she's going to give some actionable tips and tricks from the sales perspective. Where I want to start, though, is just about a minute to set the scene with the broader economy. Total non-farm payrolls in the US are 2% above where we were going into the pandemic. We've had 3 strong jobs reports to start the year, which puts our unemployment rate at 3.5%. We know there are some layoffs that are occurring in real time, but generally speaking, the broader economy and the labor market holding up quite strong. You're seeing the same thing with inflation. 2 major ways to measure inflation: PCE, CPI. Both of those are up 5% compared to last year. Now, both of those are above what the Federal Reserve's ideal target is, which is an average of about 2. But both of them are showing us that, at least as of now, we're past the peak point of the rate of change with inflation. So trending towards the direction that we want to see. Now, the challenge is when you look at the typical inflation measures, they're including shelter. And right now, shelter is representing 60% of the overall inflation calculation. And yet we know shelter has slowed, but that hasn't shown up in the data yet. Shelter is traditionally a very lagging part of the inflation discussion. And so you're probably starting to hear a discussion around super core inflation. This is services inflation, removing out energy because it's volatile, removing out housing because it's lagged. Gets us to an inflation rate of about 4%. Again, below the headline numbers, but still about double the Fed's target. Which is why, as we look at the stronger than expected economic backdrop, we know that restrictive policy is still in place. Federal Reserve has now done 9 short-term rate increases. And as we think about them, I think context is important. 4 of those were really just normalizing the market, trying to get us back to where we were before we entered the pandemic. 5 of them have actually been restrictive, trying to slow growth. But the most recent Fed increase was in March, and we know that that was also the most controversial because the increase that the Federal Reserve did was right after the collapse of Silicon Valley Bank. And I'll say I was in the camp of wanting the Federal Reserve to pause. We were going through this financial instability and it wasn't sure which direction the market was going to continue to go. But the fact that the Federal Reserve continued to raise rates was them communicating to us, we think we have a better chance of getting financial stability under control than we do of inflation. They told us the number one issue, and it's trying to get those price levels in control. Now, I think the good news is we're not opening the front page and reading about bank failures anymore, at least to the extent that we were last month. But as we saw just with First Republic's earnings, and as we track the changes with the economy, I don't want to say game over on this front. I think as we look at the economy, there's certainly a lot of risks that we need to be paying attention to. But as you think about the next move, this month, Federal Reserve's meeting again, going to decide if they want to raise rates again. My suspicion is, given the economic data still comes out strong, they're going to go through another short-term rate increase, continue to reiterate that they want to see the market slow. But as we think about how this plays into the housing market, remember that going into the collapse of Silicon Valley Bank, mortgage rates were going back up to 7%. And we were hearing in real time, both from builders and in our data, that consumers were pulling back again. Well, as we're tracking it out now, we're talking about rates in the 6s versus the 7s. So the good news is we're not as high as we were in terms of the median monthly payment. The bad news is we still have an 82% change in the median monthly payment compared to 2019. And another component of the bad news is that mortgage rates are down because there's heightened economic concerns and there's heightened economic risk. But as we think about where mortgage rates might go, think about that relationship between the 30-year and the 10-year Treasury. When we look, we know there's a near perfect correlation between these numbers, but normally, historically, you're looking at a spread of about 1.7. During times of economic uncertainty, you see that spread balloon out. That's exactly what we're seeing right now. It usually takes between 12 and 24 months for us to revert back to what would be a more normal market. And when that happens, which we believe it probably will revert to the mean at some point, that means we could be talking just from that changing alone. We could be talking about mortgage rates in the 5s versus the 6s. So it's something we're thinking about looking further out, but it doesn't change the reality of the market is responding to the affordability constraints. When you look at existing home sales, we see that we're down 25% compared to last year, month over month, down 2.4%. So down 25% on a national level. As you look across top markets, most everywhere is down compared to last year. You have a few markets, in particular in Texas, that are performing above 2019 levels. We know part of this is affordability and part of this is inventory that we'll talk a lot about a little bit later. But as you see the resale market remain muted, there's one part of the housing market that's outperforming, which is what we're seeing from builders, what we're seeing from the new home market. Now, Zonda has new home sales metrics, and then we also know the Census Bureau has them. Census released today a bit higher of a growth rate than what we're capturing at Zonda. We have a 1% month over month change right now. I think it was about 9 or 10 from the census. When you look year over year, we're down about 13% compared to last year and down about 28% compared to the height of the market. Now, as you track out how this year evolved, spring selling season far outperformed expectations. When we were talking to builders to layer in that on-the-ground feedback with our database, we were asking builders about that contract sales activity. January and February, more builders were saying they were seeing this increased level of activity. March, and then our April data through last Friday shows us that the rate of growth has slowed. We have more builders saying activity has flattened out, but holding up at really healthy levels. As we look at this though, when I talked about the existing home sales, I said part of the reason the existing home sales number is down is because of inventory. Well, luckily in the new home side, we're used to talking about sales adjusted for inventory. We like to talk about how many sales per month, per community are builders selling. This is a way to say if a builder has homes to sell, how well are they doing? Now we're comparing 3 timeframes here. We're looking at 2019, which is our healthy pre-pandemic comparison, 21, really the height of the market, and then current. What you're finding across most markets in the country is that we're off from those 21 levels. Makes sense. Interest rates have doubled, affordability, economic concerns, all the different things you can explain. We're in line with or above 2019 in most markets. Now, as we look at builders and we think about their role in the market, this is a quote from our builder survey that says, there are sales to be had as long as you adjusted to find the market. Now, this is important because we know consumers pulled back because of affordability and because of confidence. Confidence oftentimes will be out of our control. Someone will see what's happening to other homes in their market. They'll read a headline that scares them. They'll see some layoffs in their company. There are a lot of very individual specific things that will drive confidence. It can also change very quickly. But if you look at affordability, this has been one of the unique things that has driven some of the extra home building activity. Now, in the fourth quarter, demand slowed. We know that. But builders were in a place that they could adjust price or offer incentives or both to help drive activity. Now, what we did is we said, okay, well, what kind of price adjustment are we talking about? With interest rates at the sixes, we were looking at a 20% price cut would get you back to the same monthly payment as the beginning of last year. When we had interest rates get up towards 30 or towards 7%, it was a 30% price cut that was needed. There were some builders that did it. They ripped the Band-Aid off. They said, you know what, let's find the market, let's get there and let's sell homes. There are other builders that said, well, that poses some risks to cancellations, that poses risks to the backlog, to appraisals. Let's try to think of a more hybrid approach. What we find is a 5 to 10% price drop combined with a mortgage rate buy down of 5% basically gets you to the same place. This really shows the importance of the mortgage market playing into that affordability equation, plays into consumers' willingness to go through with the purchase. And ultimately, we know there was price elasticity. People were turned back to the market. And that's where the conversation gets even more complicated. Because at the end of last year, we had 50% of builders that were lowering prices, 50% of builders that were holding prices flat. As of last Friday, our data shows about 60% of builders are raising prices again. Now, this kind of works against what we know our policymakers are trying to do. They're trying to slow the economy when in fact, we're finding that prices are going back up. Question is why? Well, part of it is because I gave you some numbers that we thought was a reasonable assumption to try to find the market, get back to where we were before interest rates doubled. That's an art. It's not a science. So some builders lowered prices and they lowered it so much that so many consumers came back that they found that they actually can raise prices again. Part of it is the pricing power that comes from what's happening with the supply and demand imbalance. As you look at the end of last year, as you look at quick move-ins, these were the homes that builders got nervous about. Those are, in theory, standing inventory or homes that can be moved into within 90 days. End of last year, these were going up at a really rapid clip. You can see in different markets, you can compare it out compared to where we were in 2019. Pretty high levels for some markets. Areas that are difficult to build in, LA or Seattle, you can see that those QMI levels are down. But in general, builders offered the incentives. Those homes were worked through. We've seen this trend down, and that's what encouraged some of those price changes. But now as this has come down, this is encouraging prices to go back up. In fact, we know 60% of builders feel very comfortable with their current QMI levels because of the resale inventory backdrop. So active listings on a national level, good news, they're above where they were the past couple of years. Bad news, it's partly because those homes are taking longer to sell. We're way below where we were in 2019. And some of the listings that are coming on the market are expensive, aren't necessarily in good locations, haven't necessarily been remodeled, but they're trying to sell at today's pricing. As you look at active listings, we're between about flat in Austin on a comparison to 2019 to down over 50% in LA, in DC, in Indianapolis compared to 2019. I think we can all understand why we have inventory so tight. People that don't want to reset their interest rates, of course, makes a lot of sense. People deciding to remodel, saying, you know what, maybe I'll stay put. Maybe I'll remodel to sell in the future, but maybe I'll remodel for me. And we also know some people have pulled from the supply pool without adding to it. holding onto a home and then buying another home to use as a rental. Ultimately, what this has done is, with inventory so constrained and not seeing new listings tick up, meanwhile, builders are finally having better access to some of the supplies to help them get homes built. We're finding that builders as a share of overall inventory at 30% right now. That's up from historically 10 to 15%. Now, that's a national number looking at inventory. If you look at the new home share of total closings, you can see some markets are even above that. Austin, 40% of all the closings locally come from the new home side. Raleigh, San Antonio, Dallas, these are areas that we see big opportunity, big growth opportunities related to that builder business. But as you think about this, there's the opportunity related to the builders, but then there's also the opportunity to try to figure out how to work with the consumers. Because at the end of last year, consumers were in a place that they could maybe negotiate on price or get an incentive. There were more deals to be had last year versus what we're seeing today. And as you look at this and you think about what consumers are having to do, the number two thing that they're doing is stretching their budgets. They're looking at different loan options. They're needing to pay down debt. They're needing some kind of financial counseling. I think that's where the banking relationships come in. But we also know consumers are having to just make compromises. Looking at smaller homes is the top answer. Expanding their search radius, considering attached product. What we know is the supply and demand imbalance is tricky because you can bring more homes to the market, but if you're going to bring more luxury homes to the market, it's not a guarantee that they're going to sell. It's not just a, if you build it, they will come. It's a, if you build it, they will come at the right price. And as we're looking at what's happening with starts, because the market looks stronger than what we originally anticipated, there are more builders that want to start homes this year compared to last year. So there are builders saying, hey, there's demand. People still want to buy homes. We want to start more homes. We now have only 44% of builders that plan to slow their overall starts activity. But the caveat becomes, now we have a little bit more demand. We have a little bit more interest to start more homes. And then going back to the discussion of Silicon Valley Bank, we're also finding that credit and lending to builders to start those homes is starting to dry up. It's not even, it's not across the board. It's different public versus private, where the funding comes from, but just some early talks about how maybe there'll be a constraint on additional home building because of capital controls. But as we look at the market, we do think that ultimately starts will be down this year compared to last year. But we always ask ourselves to really try to keep ourselves in check. Are we too positive saying only down 20%? Well, yeah, we could be too positive if the recession that is assumed to happen is not mild and short. I bet none of you, or very few of you, have talked to anyone who says this is going to be a catastrophic recession that's going to last for 5 years. That's not what we think either. We don't have that baked in. If we're wrong, though, this forecast is going to be wrong. What if affordability challenges don't get better? What if credit market conditions tighten more than what we assume? In which case, our forecast of down 20% will be too positive. But there's also reasons to believe we could be too negative. We already talked about spring selling season started stronger than expected. Then builders are revising their plans of how many homes they want to start. We know housing typically slows before the rest of the economy. We're already 12 months in to a slowdown. And what if a recession is avoided? I'm talking as if one is guaranteed. It's absolutely not. If one is avoided and we start to go back in growth mode, our idea of down 20% will be off. But I think one of the most important things to us is if we can get it right, if we can make this market work, figure out how to better balance supply and demand. We know from a demographics point of view, not just the millennials, who I will talk about in a moment, boomers are retiring. That is usually a catalyst for a lifestyle change. Gen Xers, in some cases, are move-up buyers that want something different in their home. Maybe they've seen their wealth go up. Gen Z, the youngsters, are starting to represent, last estimate I saw is between 6 and 9% of total transactions. But the core group, those millennials, we know right now the largest share of the largest living generation is at these prime years to buy homes. We know if they don't already own, because by the way, you're talking move up buyers and entry level, when we're talking about millennials now, those that are entry level still have this full interest to become homeowners. But we have to ask ourselves, how do we ultimately better align home prices with incomes? And what kind of loan options are out there? Is there anything we can do to help address the lock-in effect, to help get some people to list their home and to keep these housing transactions moving forward? Now, with that, I'd like to introduce Nicollette Chapman, my friend and our VP of National Sales for Mortgage, to break it down from that sales perspective. Professionally, Nicollette is a powerhouse in the mortgage space, doing presentations across the country about new policy and helping clients strategize around new opportunities with builders. Personally, Nicolette's travel itch isn't scratched by the work trips. She and her family are heading off to Italy and Spain for a little getaway this summer. And all I will say, Nicollette, is take me with you. Let me pass it off to you.
Well, thanks, Sally, and appreciate the kind words. Obviously, I enjoy working with you. While Allie is in doing her own travel schedule and consulting with the White House, she has her own travel plans. She shared with me, headed to England and Egypt this summer. So between the two of us, we'll definitely be collecting some miles. So thanks for your perspective, Allie. Certainly one of the things that I always like to take away is the really strategic manner that is important to be able to use lender incentives. And so that's something that I always like to keep in mind and sort of really think about as we move into this market. Okay, so for those of you who have seen my presentations before, you know I love a good sports meme. So here we are today in the middle of the NBA playoffs, and Draymond Green is really not that different than the Fed. A lot of people think that the Fed deserves a technical and a medium one meeting suspension. But honestly, if you watch the game, you know that Sabonis still found a way to win. And I think that's what we have to keep in mind in this market. Leverage those opportunities that exist in order to really set yourself apart. I think key pieces in this particular market are providing education to what's actually happening in the marketplace and really sort of dispelling some of the myths, as well as providing solutions that are unique in order to be able to set yourself apart. Now, we knew that the Fed are kind of considered the bad guys, but just when you thought that blows were limited to the Fed, Fannie and Freddie say, hold my beer. So with this new introduction in January of loan level pricing adjustments, we know that they do have a potential to really sort of damage that buyer experience, or in some cases, a buyer's ability to close. But just when we thought that the GSEs were terrible, the media is making our lives miserable. As a lot of you have probably seen, there's been a ton of news that's been created recently in order to create more drama than really providing data. And let's start with those loan level pricing adjustments. So we've seen since the last week, Biden raises costs for home buyers with good credit to help risky borrowers, or the Biden rule will tax home buyers with good credit to lower costs with those with bad credit. And we know that that is not the case. These loan level pricing adjustments have been announced since January, because we're dealing with a May 1st delivery date on this first round that involves credit score and LTV. Now sort of people are understanding what's happening, right? So if we look at this sort of graph here in a heat map of new versus old for purchases, we can see that anything in red is sort of taking a little bit more of a hit in terms of those loan level pricing adjustments. Anything that's green is sort of seeing a benefit. And so across the board, we can see that loans with less skin in the game or riskier loans seem to be getting the most pricing improvements. Across the board, we're seeing high LTVs, low FICOs getting a little bit more of assistance, whereas those putting 10 to 25% down with FICOs, from 700 and up are quote unquote being punished. Now, this isn't really about punishing or rewarding. It's about trying to get more people in the market in an affordability and rate challenged market. Now, if we actually look at the FICOs on the outright, we'll see that a 640 FICO is still going to pay significantly more than a 740 FICO. So if we use an 80% LTV ratio as an example, your loan level pricing adjustment is going to be 2.25 versus 0.875 for a 740 FICO score. So that's a difference of about 1.375 or just over $4,000 on a $100,000 mortgage. Now, that is significant, but it's almost half the previous difference. And so certainly that is a big change. Now, just as we finally get people acclimated to the new LLPAs, we have to remember that we aren't done. We still have a whole other round of DTI-based loan level pricing adjustments that are going to be effective with an August 1st delivery date. So keep in mind that borrowers with a DTI over 40% are overwhelmingly hit unless the LTV is under 60%. Now, this is interesting because we are dealing with that affordability challenge market. So debt to income ratios are going to be impacted by this. Now, it's worth noting that if you have extended rate locks out, your buyers can be impacted. Lenders should absolutely right now be prioritizing those conversations with their builders on how they plan to address those loan level pricing adjustments. Again, over communicate, under promise, over deliver. Now, another problem that we're dealing with in terms of incorrect information from the media is this 40-year mortgage that's out there. So we can see this headline, FHA approved 40-year mortgage for certain home buyers in May. Well, the reality is that 40-year mortgage is for loan modifications for people who are already in default, right? So using a word of home buyers instead of homeowners is only sort of starting to really push that narrative that is incorrect. So again, really important right now that we are doing what we can in our community in order to educate both builders, realtors, and buyers on what the reality of the market is. Remember that those that survive don't do so by being smarter, stronger. They do it by being adaptable. And so as Ali pointed out, we have an extremely high percentage of inventory that's new construction right now. If you aren't working with builders, you really need to be thinking about doing that. Right now, the national builder opportunity is just about 30,000 unique builders across the country. There is no reason why you shouldn't have some of that share. Now, in our last 3 minutes, I want to recap the current origination landscape. Number one, the most recent MBA forecast for 2023 originations is a total of 1.8 trillion, which is still a 20% decrease from last year's total. And all of us know that last year wasn't exactly our best year. Now, purchase volume is expected to decline 13% to 1.37 trillion. And as I stated earlier, 35% of inventory is new construction. With limited purchase transactions available, do not wait and shift to diversify to builders if you want to continue to be in business. Number three, loan level pricing adjustments equals opportunity. Find builders and educate them. You have something meaningful to talk to them about and then provide a solution. Another piece I want to point out is acquisitions and mergers. Know where they're happening within the mortgage and banking space and how you can help protect a builder's pipeline if their lender might be part of one. So for those of you who use our Mortgage Pro platform product, you know that we can track builder capture detail to really sort of understand the trend of a lender's relationship. If you know that a mortgage company that works with the builder is going underneath an acquisition, it's a great way to be able to get in front of them and provide a solution if that might be necessary in order to protect their pipeline. Extended rate locks, permanent rate buy downs, and unique affordability solutions matter. Really dig deep and know your programs. It isn't enough just to be a loan technician. You have to be a creative loan technician. Understand maybe how you can help them refinance their car into getting those DTIs to work. Get them underneath those LLPA limits. Know those guidelines, know your market, and then obviously know what your competition offers and be ready and willing to provide a stronger solution. And that leaves us just at the end of this webinar today. We do want to thank you for attending. The recording will be posted within 24 hours on our social media channels and our blog. If you registered for this webinar, you will automatically also get a link. In the meantime, we do encourage you to follow us on our social media and subscribe to our emails for upcoming webinars, economic reports, podcasts, and more using the QR code on the screen. Thank you again for joining us today. Ali, thanks for your time and look forward to our next webinar.